So look, it's great to see such good progress this year. It's particularly heartening to see such good progress in the last few weeks and even in the last few days. So I'm heartened by that when I look at what's going on politically. But we've still got some way to go, obviously. I don't want to be too joyous about the progress to date. But if we look at the journey's been much longer than that. It's been significantly longer. It's 10 years since the G20 set a path to how we could have a coordinated approach to resolvability. And the idea was to avoid taxpayer bailout as well as systemic disruption. So the FSB's key attributes gave us that path. They told us the way we could go. And at the heart of that key attributes, in essence, is a question of balance. It's a balance of lots of issues, and all the panelists mentioned balance. I was quite pleased to see today, because I think it's absolutely key when we think about any of these issues in the resolution package. It includes a balance between resolution powers and contractual rights, the legitimate expectations of private individuals in some cases. And it's also about the balance between home and host that we hear about so often in the debate. So those are very important. In the few minutes I've got left, I'm just going to talk about internal MREL and moratoria, two of my favorite topics. I'm sure everybody likes those. But I think in both cases, there's a real risk that we're going to get this balance wrong. You know, if we don't get it right, we've got essentially less certainty for creditors, we've got fragmentation of capital and liquidity, and we've got member states hoarding resources unnecessarily. So all of that has got significant negative consequences for cross-border banks like ours, and like many of the banks in the room. But it's also got very negative consequences for European competitiveness, in my view, at what is a very delicate time. So just taking a look at internal MREL then. If we look at the FSB's aim, it was that if we have sufficient external TLAC, internal TLAC resources prepositioned in material subsidiaries could create the balance we needed. The incentives essentially to ring-fence capital would be significantly reduced. So internal MREL acts like a down payment on trust and cooperation, right? But it happens before the resolution takes place. The idea was that you secure this balance and bolster the trust that sits there with this down payment. Hosts would be less likely to ring fence, home authorities would be less likely to cut off subsidiaries, and we get to the right result for cross-border business. The Commission's proposal to introduce what effectively is a 90% floor, in my view, undermines that policy objective. And there's three reasons for that, essentially. First of all, if you set internal MREL requirements so high across the group, that's going to reduce the amount of surplus MREL that you have, that can sit at the top of the group and provide cover, flexible cover for circumstances that are unforeseeable. And contrary to the intention of the package, if we have too high internal MREL requirements, we're going to have a much more brittle, much less flexible group that's less able to allocate resources across the group. So that's worth bearing in mind. Secondly, of course, if you start with a 90% floor, you also increase the risk that your internal MREL requirements are going to be the drivers of group external MREL requirements, the sum of the parts issue that we always talk about. Now look, the MREL debate continues, and it's probably got center stage right now, so I don't want to prefigure that. But I'd ask the question, do we really want internal MREL policy to be set at a level that it's going to dictate external MREL policy? It's an interesting balance we've got to strike there. My view is that it's preferable to set a range, as the FSB dictated in its term sheet, 75% to 90%, so that then we can have a discussion in CMGs, we can have a discussion between home and host states, that's a discussion that's specific to the institution and specific to the issue at hand, rather than having a blanket 90% minimum. Finally, the start on internal MREL, setting that high starting point sends all the wrong messages, in my view. It contributes to this collective action problem that we've got, where each regulator is going to be competing for these resources. Which regulator, which resolution authority is not going to actually want to have a 90% level if everybody else does, put very simply. You know, we've already got a 90% level in the US for US IHC requirements. But in my view, retaliation to the US approach is not the right way to go. It's not the right policy response to this issue. And an arbitrary 90% level across all jurisdictions to me looks like a poor outcome for resolvability. It's a poor outcome for trust and cooperation, even before the resolution started. And it's a poor outcome for cross-border banks who have to hold increasing amounts of resources, perhaps unnecessarily. And as I mentioned, it's also a poor outcome potentially for financial stability if we have more brittle groups that are less able to adapt to idiosyncratic risk events. So I know significant numbers of the Parliament amendments appear to recognise these issues, but I'm not sure this issue has gained the traction that it should in the Council negotiation at the moment. So I'll briefly touch on moratorium in the short time I have. There's a lot of options being considered on moratorium. Excuse me. But I think, again, this is another area where we've got to fight hard to find the right balance, and that balance is significantly under threat with moratoria. We'd prefer to see the moratoria deleted altogether. I think the policy rationale for the moratoria is questionable. If you look across the debate, if it's just to give the SRB more time, are there other ways we could achieve this? Could planning be better? If it's to harmonize other moratoria, arguably there are moratoria out there. They tend to relate to insolvency, not resolution. There is a very significant difference. And if it's because member states have failed to harmonize the way in which they implemented BRRD, then there's other ways to achieve that harmonization as well. So I'm not sure this is the right tool for that. If it's to stop liquidity outflow, as perhaps is now the dominant policy rationale for this, then, and depositor-led bank runs, then I think we really have to ask ourselves about the balance again. And the ECB recognized this in their opinion on this. You know, they suggest that 5 days is okay to stop the negative implications of the moratorium making depositors more flighty and more jittery. But why is 5 days okay? Is 10 days okay? Is 12 days okay? I don't think that's been investigated sufficiently, so we need to give that further thought. My view is that we have to live with some degree of pre-resolution moratorium, then we really like the look of the Bulgarian presidency compromise. For the pre-resolution moratorium, I think the compromise works because it suspends performance and prevents termination for 2 days only. It can't run consecutively with other moratoria, and it occurs after a failing or likely to fail determination. So in essence, it really looks like Article 69 and Article 71 moratoria that we currently have, just occurring much earlier in the piece. I think if there are changes, either to the maximum duration of either of those stays, I should say moratoria, or the moratoria are allowed to run consecutively or be applied numerous times consecutively, which is possible, and some of the iterations we've seen suggest that, then that would cause a significant number of problems for EU banks. You know, first of all, these changes will need to be assessed by bank customers, by depositors and by counterparties. If the balance is wrong, frankly, they may choose to bank or to contract elsewhere. If the balance is wrong, when problems arise, depositors get more jittery. So we've got to bear that in mind and really think that through, as I mentioned. Secondly, the market needs to assess these new risks. There's going to be, with these moratoria in place, there's going to be a much more extended period of time when contractual rights are suspended. And think about it, that's a pretty odd thing to do, suspend contractual rights if you're a contracting counterparty. You enter this zombie state where you don't have to perform, but you can't terminate. No one has to perform, no one can terminate, no one can close out. Ultimately, if you're assessing margin requirements for a counterparty, you need to take this into consideration. This zombie state doesn't persist. Market risk doesn't sleep. You know, it's going to change. The value of your contract's going to change. So you need to address that, and you'll take more margin. So if we move today from a margin period of risk for most derivatives of about 10 days, which is, you know, the bank estimate for how long it takes between a default and actually delivering a closeout notice, then are we saying margin period of risk should be 15 days or 20 days? To me, that's an incredibly significant increase on what we have currently that we need to really bear in mind. And thirdly, if I have just a few more minutes, is, you know, this is problematic for netting, and we've heard it's problematic for netting for US banks. We've done a lot of work to look at that. We've spoken to US counsel. It certainly seems to be the case. The reality is, whilst you can fix netting problems intra-Europe with European legislation, you can fix insolvency moratoria by introducing the Financial Collateral Directive. You can fix the issue of non-performance and closeout and netting in Europe by suspending payment and delivery. you may not be able to create those fixes externally outside the EU, and that's certainly proving to be the case from what we're hearing from the US. So when they look back at Europe, they look at it very differently. It may also well be the case that, you know, counterparties with non-EU law-governed contracts look at this very differently and have a different outcome, potentially. So we need to be careful of that. As a passing shot, you know, make no mistakes, losing netting treatment under US law is a very big deal for EU banks. There's very few countries left with significant banking industries that are in the non-netting club. This would put the EU on a par with China in terms of legal predictability and legal certainty in terms of contractual agreements like derivatives. To me, this would be a clear indication that we got the balance wrong. That can't be the right outcome. And the reality, if we don't get netting right, the reality might just be higher dealing costs, but more significantly than that, it might be capacity issues. And if you look at some of the estimates that ISDA is producing and the increase in RWAs, the reality is it's going to be very hard to maintain current volumes of derivative activity with EU banks who want to hedge with US counterparties if they are not net. That's just the reality, so we need to bear that in mind. I'll stop there, but in both cases I just urge Parliament, Council and Commission to look back where we started and to really think about that balance. And I think the survival and the success of the EU banking sector substantially depends on it. So no pressure there. Thanks very much.